Paul, we got this one off the request line. Wayfair stock. I literally said I have no damn clue what the heck this is, and you're here to enlighten me. What is Wayfair? I thought it was a furniture, but I guess they sell a bunch of stuff. What is Wayfair, and why is it in the news?
So we actually sell through our company, Blue Door Supply, bdsupply.com. Check it out. We can buy all your home improvement needs. Yeah! We sell a lot of light fixtures, vanities, other home products on companies like Wayfair. Mm-hmm. It's our brand on these companies, right?
Oh, nice.
Wayfair was a company that skyrocketed in price. This was the bottom of the market right here.
End of March, COVID.
It was like $60 a share. Now it's at $3.10.
Oh my Lord, why?
So it's been in the news. They've grown a ton. The online sales have skyrocketed for them. So we get a lot of people requesting these things in our chats.
We are going to do the 8 pillars right now. Paul's 8 pillars, looking at the health of a stock and whether it's a buy, a sell, an indifference.
It's only been public for 5.5, 6 years.
Okay, so there's not much to look at. But
it'll be good to go look through it because I want to show you guys, a company. Look at the stock price right here. Look at how much this is like. Look at how incredible this is. I mean, this is all literally in the last 6-7 months.
All right, let's get into it. 8 pillars. Pillar number 1 is PE ratio less than 20. This is the price to earning.
Well, guys, I'm
telling you right now. This is what is it? There is no PE. What's going on?
Why is there no PE?
I have no idea.
Because it does not make money.
How do they not? I'm sorry?
It does not make money.
Uh-oh.
It's a very simple solution. Their PE is negative.
This sounds like a healthy company then.
Well, listen. I mean, we'll go into that part soon, but the bottom line is big fat what, Seth?
X.
Big fat X on PE doesn't make money, less than 0. We won't worry about that right now. Again, this is an important factor, but it's not the be-all and end-all. If there was a path to profitability that can make the company very valuable, we would look at that. But right now, that's a big X. Next one.
Pillar number 2 is profit margin.
Okay, we want profit margin to be what, Sethy?
At least 10?
At least 10. What is it here?
6 1/3.
6.4%. Now, their gross margin's 30%. That's pretty solid.
Okay.
Because we're selling a lot of stuff through them. So we put our products on there, they take a piece.
Yes.
So for them to have 30% margin on that, being the middleman, that's pretty solid.
Mm-hmm.
But they're right now only making 6.3%, 6.4% in the quarter.
Okay.
The reason I didn't look at the PE a little bit as thoroughly because I want to look at their most recent quarters and see how they've done as they've grown more.
Okay.
But right now we have another X here, another X on the profit margin. But again, young company, a lot of growth potential. Let's go on. What's the next one, Uncle Seth?
Pillar number 3 is revenue growth over the last 5 years.
This is going to be very impressive.
Last 5 quarters. Yeah.
Let's look at the last 5 years first.
Okay.
Ready? 2 billion, 3.2, 4.7, 6.8, 9.1. Is that good?
Yes, green check.
That is phenomenal. Next one.
Paul, we're at pillar number 4, profit growth. You started laughing at this.
This is awesome. Negative 80, negative 194, negative 244, negative 500 million, negative $1 billion.
They literally, okay, so.
They're getting worse every year.
Explain this to me.
I have nothing to explain to you. I'm just telling you what exactly it is. They're losing more money as the years go on. There's nothing to explain. It's just they're losing more money.
But I mean, new companies lose money to grow, right? I mean, or...
So that's the theory behind this. One of the things we like about the 8 pillars is it's a very simplistic way for you guys to see what's going on with the stock. One of the things that people have been asking, the things you guys have been asking is, Paul, can we go past the 8 pillars? Yes, we can. But one of the things I'd tell you is you have to understand why are they losing more money. One of the things you have to do some research on is why does their losses increasing over the last 5 years? As they grow, Amazon had the same problem, by the way.
Okay.
So remember that. Amazon had the same issue where they weren't making more money. They were losing money for I think the first 17 years of Amazon's existence, they didn't make money. In the sense of over that 17-year period. Mm-hmm. Every once in a while they'd have a profit, but they were growing a ton. This might be the same situation here. But this is definitely a big fat X for me.
Pillar number 5 is number of shares outstanding. We want this to be decreasing, and I would think with this company, it looks like they're most likely increasing shares. Wouldn't you think, Paul?
Yes. So this might be hard to see. 70 million, 70, 50, 84, 85, 87, 89, 92.
Increasing, another X.
Increasing, another big fat X. And for a young company like this...
This is terrible.
I don't really like that because I guess they're probably using it to acquire people is my guess. They're probably using shares to acquire people, which you know how much I dislike that.
Okay, current assets greater than current liabilities. Pillar number 6, current
So we go to the balance sheet here, guys.
Greater than current liabilities.
I'm going to go to the most recent quarter. And we're going to go total current assets, everyone, $2.9 billion right here.
Wow.
Okay? Total current liabilities, 2.28. So they have enough.
I'll be darned.
So we finally have our first, nope, it's our second check mark. Sorry, what was our first one?
Profit margin, revenue growth, of course.
Revenue growth, that's right. So it's our second check mark so far. Next one, Uncle Seth.
Free cash flow growth, which
Seth,
is
what's my next question going to be?
cash from operations
Yep.
minus capital expenditures.
Very good, Uncle Seth.
Now, we still get comments down below, which is rightfully so. It's a confusing topic. So explain it one more time, Paul.
So
what
cash
that
from
is.
operations is the money generated that the business itself generates, right? Doesn't include financing things, investing in it. Just what does this business by itself generate? Capital expenditures are their investments back in their fixed assets, their property, plant, and equipment. Because at the end of the day, if you have to put a lot of money back in your property, plant, and equipment, that should be deducted as part of your cost of doing business.
Yeah.
People, a lot of accountants will sit there and say, no, it's not a cost. It's a real cost. If it's repeated over and over, you need to do that in order to grow the business. So we take it out of our assumptions on free cash flow. Mm-hmm. Free cash flow is then used to go pay dividends, make acquisitions, do all the things, grow faster, etc. The more free cash flow a business has, the more it can do to grow. Over a long period of time, your net income and free cash flow should be about the same. If they're not, there's a red flag in there somewhere.
Go ahead, Paul.
So, free cash flow the last 5 years. 73, negative 66, negative 110,
Oh, boy.
negative 140,
Come on.
negative 205. That's getting worse every year. Now, the good news is it's very consistent with the profit getting worse every single year. But this is getting worse every single year. Again, this is a fast-growing, small, new company. So we don't necessarily, but the problem is, what I would sit there and say to the average investor, I know we still have one more to go, but it's a negative number anyway. Then the last pillar, so this is an X. And the last pillar is your average of the last 5 years free cash flow divided by the price. Well, the average is negative. So it's another X. So there's two X's here in the last two pillars. We only had 2 check marks. Guys, for you guys out there, the average investor out there, I would stay away from this company. If you're willing to go to the next step, which is read 10Ks, understand where the business is going, I would say, okay, maybe so. But one of the other things I want you to sit there and look at is their company is worth, right now in the market, $30 billion. 9 times their last year's. Now, okay, you know what? One thing I want to look at is, let's look at the last income statement over the last 2 quarters.
Go on.
Because in the last 2 quarters, they've grown a ton.
We're growing as well. If you can smash that like button in the bottom right corner down there, the thumbs up button will be very helpful. Paul's giving you all this information for free.
All I ask is
Smash the like button.
like, subscribe, tell your friends.
Love it. I dare you, double dog dare you to share this with somebody right now. Press that little share button and send it to one of your fools who's investing with this stupid company. Paul, keep going.
So here's the cool thing about the company. In June of 2019, that quarter, they did $2.3 billion in revenue.
Go on.
This June, they did $4.3.
Wow.
In June of last year, they did $181 million loss. This June, $274 million profit. They finally had a really big profit for a quarter. They hadn't had a profitable quarter in how long? This is going back to first quarter of 18. They finally had a profitable quarter. So one thing you have to sit there and do is do some research into the company and say, is this profit going to be sustainable? And if it is, what is the company worth from this standpoint? Mm-hmm. Let's say they make $300 million a quarter for the next 4 quarters. That's $1.2 billion in profit. The company's selling for $30 right now, $1 billion in profit. Divided by 1.2 equals 25 PE. It's still a little expensive, but
Not ridiculous.
it's growing a lot too. So this is sustainable, and that's a big if that you have to go out there as an investor and do and decide. For me personally, I would not buy this company yet. I prefer to buy myself more established companies that have a more concrete vision for the future. I don't know if they do or not, but I don't like seeing all these losses along the way and suddenly all of a sudden big profit. There's other ways to manipulate that number. I don't know if it's going to happen or not, but one thing you have to understand for yourself is, can we make this work? Now, the great news is $4.3 billion in revenue in the last quarter. Man, that's huge. If you do that 4 more times, that's $18 billion $17.5 billion in revenue when they did 9.4 last year. So it's going to double potentially in the next 12 months. This is one of those interesting situations. You have to do more research to understand if it's the right stock for you.
Can you please explain to our viewers right now why you never actually bring up the price of a stock, which for me in the last 10 years of investing, that was the only thing that ever mattered was the price of the stock. Why does it not matter on the Everything Money Show? Tell me.
All I care about is what is the total value of the company based on the price of the stock. Remember, we can have the price of the stock be whatever we want by changing how many shares outstanding there are. Do a stock split, do a reverse stock split, we can do that. What's behind that price is what matters. The same company two companies can have a $40 stock price and a $500 stock price and be worth the exact same amount of money based on the number of shares outstanding. So as an example, let's go to a screen here.
Now you talk so dang fast. I'm still confused. Like I tried to think of this in like layman's terms, normal people. Like
let's say this company has $1 in stock and company B has $10 stock price. Which one's worth more? Most people would say this one, right?
Yeah.
What if I told you this has 10 shares outstanding?
Oh, 10%. You own 10% of the company?
And this one has 1 share outstanding. The market cap is 10 times 1, which is 10, and 1 times 10, which is 10. It's the exact same. The price doesn't matter in and of itself. What matters is the price and the number of shares outstanding. Right?
Yes.
You look at me like I've never told you this before.
Well, I'm just trying to.
It probably shows that a lot of people have the same confusion. The price of the stock in and of itself is not what matters. What matters is how many shares out. That's why we look at how many shares, are the number of shares growing or not. Because if they keep increasing the number of shares out there, it's going to hurt the value of it's going to make this price go lower. That's getting into very intricate details I don't necessarily want to get into here. But the bottom line is, people, you need to look at the market cap. Because the market capitalization is the number of shares outstanding multiplied by the share price. That is the true price. You have to assume you're buying the full company. Whenever you buy a stock, you have to value it like you're buying the full company. Would you pay that full price for the company? Would you pay $30 billion for Wayfair? That is the question. How many shares they have outstanding is irrelevant. It'll determine that. I mean, what the price is irrelevant. The number of shares outstanding will determine it.
Okay.
You have to look at the total value of the company based on market cap. That is what you're paying for the company.
I'm baffled.
I'm sorry. And you know, I think this is a separate video we need to do all together. And we need to reference this video all the time because it is a very common occurrence that I still remember. I told you in Algebra 2 Trig, I remember Mr. Ritchie saying, I wish I could afford Nike stock, but it's too high priced.
Yes.
Too expensive. And I was like, no, it's not. It's not. It's based, just because it's at the time $75 a share. I'm like, come on, give me a break. That's the way everybody thinks. That's what you all think of, which I get. I used to think the same way when I first started learning about stocks.
Yes.
Berkshire Hathaway sells for $300,000 per share. It's cheaper than Wayfair. Wayfair's at $300 a share. This one's cheaper. Berkshire Hathaway's cheaper because the number of shares outstanding, the value of the company relative to the what's behind it is less than this. You're buying more at $300,000. If you were to buy 1,000 of these shares for Wayfair for $300,000 worth, you're getting more from Berkshire. You're getting more cash flow, more profit, more assets, all that stuff. So in order to compare, you have to look at the total value of the company. I know this is confusing. We have to go into this more and more detail. But don't ever just look at the price per share. You have to look at the market cap.
At what price are you buying Wayfair?
Oh, I don't know right now. And that's a good question. A lot of people are asking us that one. So one of the things I want to do is I ordered a new computer so I can show you guys my model that I make to show you guys more of a price range of where I'd look at a company. That's something we're going to get into in the next few weeks. The computer's on its way. It'll allow to be able to sync up with all of our other things so we can live stream feed it. And I will give you guys more of a range of saying like, okay, I'd pay blah, blah, blah to blah, blah, blah. Whatever it is. But that'll happen. But to go back to it, you need to look at the market cap of the company as the price of the company, not the share price. We never ever look at share price as a way of valuing the company. We look at the market cap.
Thanks for joining us on the channel. Make sure you like and subscribe down below. Comment if you disagree with Paul. I don't know how you can disagree with these numbers. They are making a ton, but good Lord, they're losing a ton. Thanks for watching us on the Everything Money channel. See you guys.